Hello. In our first update of 2023, we will be looking at how construction is navigating the current economic conditions and what to look out for in the coming months. So far, we have seen positive signs that the uncertainty of the last 12 months may be behind us, as we move into 2023 with a strong forward pipeline of work. This quarter, we're advising our clients, in a stabilising market, identify your advantage. To achieve this, we recommend you speak to the supply chain to spot key buying windows, remain aware of fluctuations in material prices, and keep an eye on the construction labour market. Today, I'll run through a macro overview of market conditions, Mike will cover construction output and key updates on materials, and Katie will close on what's ahead for the labour market and the impact of energy costs on trades with a focus on facades. From the data, we are seeing inflationary pressures ease after a 41-year high in October. The recent downward trend in construction price inflation was driven mainly by lower fuel and energy prices. However, we remain cautious that the pressure on the labour market and the volatility in the energy sector may put pressure on construction costs in 2023.
Overall construction activity declined in December and January due to weaker demand and fewer new project starts. This was accompanied by a softer rate of input cost inflation. Lower demand for construction products and materials, cutbacks in input buying and improved materials availability meant that input cost inflation was the softest since December 2020. Construction output rose marginally in Q4 of last year, reaching another record high of over £45 billion. Meanwhile, according to purchasing managers, business expectations showed increased positivity, with improved sales pipelines and hopes of a turnaround in new orders during the first half of the year. Last year, materials were the main driver of construction cost inflation. On average, prices rose 11.2% as manufacturers passed on rises in energy-related production costs and commodity price increases. However, we've seen material prices soften in recent months as both these elements stabilised and began to fall. One to watch over the next few months will be the price of concrete. Although we've seen a fall in supply costs across many key materials, such as steel, concrete and cement prices continue to rise. This is partly due to the material having a localised supply chain. This gives suppliers greater pricing power and therefore less need to pass on reductions in raw material or energy costs.
Let's focus now on the labour market and the impact of energy prices on facades. First, labour rates. The construction labour market remains tight. As construction activity and client demand has eased, we've seen employment levels falling and advertised vacancies dropping from their historic highs. This would normally point to reduced labour rates. However, structural challenges remain and are likely to sustain an upward pressure on labour rates. Industry is facing three key challenges: the cost of living crisis, an ageing workforce, and reduced access to overseas labour following Brexit. Because of this, labour is likely to be a key factor in construction costs for 2023. Now to facades. Looking ahead, we can see a more stable energy market and reduced inflationary pressure on material pricing. However, for facades, we're anticipating higher inflation to come. A period of volatile energy pricing has had an impact on the cost of glass and aluminium. Add to this a small pool of facade contractors and the demands of net zero carbon targets, and we anticipate higher inflation to come in this trade. When it comes to facades, we recommend early supply chain engagement and clear client requirements to best manage this risk.
If you want to find out the details behind the headlines, read about it in our Market Intelligence website. Follow our channels to keep up to date or get in touch to speak to one of our market experts today.